And we're live. It's 10:30 a.m. on the West Coast, 1:30 p.m. on the East Coast, 6:30 a.m. Australian Eastern Standard Time, which I think means it's 6:30 p.m. UK time. How you doing, fellas?
Living the dream. Happy to be here.
Confined to quarters again in California.
Oh yeah.
What's up?
We're confined to houses again in California, but my little fella's finally had his first day of school yesterday.
That sucks that you guys are locked in again. I didn't realize that.
I don't know how it works.
To tell you the truth, I don't really notice a difference yet. I don't know if you've...
Yeah.
No, there's no difference.
People are still just kind of going about their lives.
Congrats to Donald Traynor, who got released from Guantanamo Bay and is now in Carlsbad, California, just in time for the lockdown in California.
Oh, God.
He's probably better. Anyway, whose turn is it to introduce the episode?
I kind of feel like I haven't done it
Probably
in like
JT.
6 months. Maybe
Yeah.
I should do it, huh? I try to hide from that. Welcome, Value After Hours. I'm one host, Jake Taylor. We've got Toby and Bill. Toby, what do you have on deck for today?
I've been looking at a few of the more interesting names out there just in terms of their reinvestment rates and what the kind of future might look for them as a group. I just sort of want to talk about capital allocation with you guys a little bit, just bat it back and forth and see what you think.
William?
I'm going to talk about why I invest actively.
Ooh.
Big thoughts. Big thoughts.
Big and deep.
What are you on, JT?
I've got a little segment prepared that I'm calling Magic Numbers. We'll see if it's worth a shit or not. But I guess right after this.
Who wants to take it away today?
Hey, real quick, though, before that, dude, I think everyone who's listening, if you guys are fans of what we do on this, Three Bozos, you're going to love Two Bozos.
Shout out to the main homie, Greenbacked.
Yeah, you guys are going to like this. I think you're going to get a taste and a view of Toby that you've never probably had, and I think you'll enjoy it. So looking forward to that one.
Bill and I did a 3-hour interview, and the first hour I was able to maintain professional cover, and then
Decorum,
you just forget 2 hours in. I forgot that I was on a podcast. It's very dangerous.
I was listening to it, and the amount of times that we referred to each other as dude, I was like, okay, we sort of duded out on this. I mean, I might as well take it because it's actually a reasonably good segue. I've been struggling to work lately, like pretty hard, and I know that a lot of people are like, yeah, dude, everybody is, shut up. But like there's something about coming up with a really good idea that takes a lot of creativity and like real energy, and I have not had the motivation to like really pursue that. And I think this podcast has a fair amount. Like this is like my passion project right now, right? So I'm sort of like my attention's diverted. And I found myself thinking like, well, like the S&P is racing and what am I doing? And like, I'm going to fall behind and I'm going to outperform. And then I sort of or underperform, right? And then I took a step back and I was just kind of like, why am I doing what I'm doing? Right. And I guess I'm in a different position than a fund manager. Right. But fundamentally, like the reason that I do this is I really, really enjoy life as an investor. And right now I'm just kind of taking a pause from that. And I realized that, maybe putting the pencil down for 2 weeks to pursue other stuff or let your brain rest, like really isn't the end of the world. And I found myself feeling like I had to work, not all the time, because I mean, I'm obviously dicking around on Twitter and stuff, but like my brain was always stimulated all the time. And I think that like taking this time off, I don't know, has been like a real brain rest. And having this podcast side project has helped, right? And it's not exactly a brain rest because I'm like obsessed with that thing, but it's been nice to have something else to do.
Would you say that if it was March 2020, maybe it's not like the opportunity cost of taking a break would be pretty high, but where we kind of find ourselves today might be like, I'm going to go for a walk instead of like really trying to force it.
Yeah, I would say that. And March was so like adrenaline driven that I didn't even want to walk away, right? But now And I think it is sort of the culmination of a big year, just sort of like, I don't know if it's New Year's and just got me thinking about like, what the hell am I doing? And maybe just relax for a bit instead of doing whatever. So I don't know.
I noticed there was a dramatic drop off in the amount of email that I got after Thanksgiving. Like since the last week and a bit, I think people are tired. People got to get it all done by Thanksgiving, and then after Thanksgiving they're like, "Whew, that's 2020 that's 2020 done. 2020's in the can."
Well,
See
I've got a lot of,
2021.
like, family stuff I'm working through too, so that diverts some attention. But like as far as what's going on in the market, I just could care less.
Yeah, I mean, everything's so expensive at the moment. I find anything that I think is interesting that I look at, in a discretionary sense, is like just 60% overvalued, 60% to like any kind of conservative kind of valuation for good stuff.
Melt up.
Tina.
But here's the thing. So if we melt up, then, what are you going to do?
Then I'm gonna sell everything and just hang out.
Yeah.
What if I told you that we already melted up, Bill?
Then I'd have to hold some stuff.
Okay.
I'm fine. Like, I mean, whatever. If you want to sell some of the stuff I have, I don't really care.
I dug through.
Which is the nice thing about owning some quality shit.
I went through some of the names that people have thrown out on the podcast, on my other podcast, just to sort of see some of the names that people more deeply research. And I had a look at Trade Desk. Have you guys seen the chart on Trade Desk?
Yeah.
No.
I've seen a lot of these charts, and I've seen that chart.
I think that one. They're all. Here's the thing: they're all very similar. All of these stocks sort of basically take off in like 2018, and they all go from probably being undervalued in 2018 to being like very overvalued now. But Trade Desk is the most egregious one that I could find so far. Like for the ones that I've kind of looked at that I'm interested in owning. Trade Desk is. If you guys pull up the chart on that one, just set your faces to stun. That's pretty impressive.
Well, it's a lot of them, and that's sort of when like, look, if all of them do the same thing, I just don't buy that every company has gotten that much better. I just don't.
Well,
now,
the underlying hasn't done that.
What?
The underlying hasn't done that. It's just the price.
Yeah, that's right. And the perception. And to be fair, like they did accelerate a lot of adoption of tech, and that is a big barrier to adoption. And now people are more integrated to it. I don't deny that. I'll tell you what, I am tired of Zoom and I am tired of Peloton. Like those two
the
things,
stocks
I am just
or
bored
the
of.
things.
No, the things.
Oh yeah.
Like somebody asked me the other day, do I want to get on a Zoom call? I was like, no, just call me on the phone. I don't want to see your face.
Yeah, that's right. That's a thing, right? The fatigue of having to stare at people all the time.
Yeah.
Are you tired
if
of
I want
riding
to
your
pick
Peloton
my
now,
nose
too?
on the other side of the phone, I don't want you to see it.
Are you not riding your Peloton now?
I just did.
Oh, I thought you said you're tired of it.
I am a little tired of it, but I wrote
Okay.
it. I'm missing the gym.
What we need is a subscription service for a bike that you can take outside. It's like $29.99 a month. We'll sell you the frame. Anytime your tires go flat, we'll give you a
And
tire.
it goes places.
And it goes places. It's outside.
thing
Incredible
is,
scenery. So
want-
realistic.
I want music and I want a trainer. That is what Peloton. That's the
We'll throw
one
in some
argument, like-
AirPods.
We'll tape an iPad to it. Don't worry about that.
yeah, that's fine. Yeah, just charge me $2,000 and you got something. The thing about it that I was thinking about this today, could you bring Peloton to the gym? And I think you could. I think it could travel, but I do think it's going to be weird to have your phone and your trainer with you at the gym.
As in,
It's going to be odd.
There's a Peloton in the hotel and you log in as yourself.
Yeah, but there's like actually an app, right? And it's on your phone, and it'll have your workouts, strength workouts, and whatever. I mean, it's a personal training program as well as a bike. It's just the personal training is
Not that personal.
That's
Impersonal.
right. Yes, it's more of like classes through a screen.
It's arm's length.
Yes, it's COVID appropriate training.
Where's Peloton trading now? Like, is it a?
It's got to be
In terms of
Are you
valuation?
sitting down?
I'm about to be.
hilarious.
Yeah, make sure you're sitting down first.
Oh my God, this thing's a $35 billion company. Get the fuck out of here.
What's it making?
What a ridiculous valuation. I'm sure somebody's like, I got about my whole fund in it. You don't understand. All right, whatever. You may not. Anyway,
What's it make?
What in cash?
Yeah.
I don't know, dude. You're gonna make me go through all this
I
stuff.
just
The
thought-
valuation is screamingly high. That's the answer.
I mean, if it's
People are underwriting some big, hairy, audacious goal of 100 million users. All right, we'll see how we're doing in 2 years. It may work. Like, it may.
100 million users globally,
Yeah. Look, dude.
not in the
all I'm
States.
saying,
2
this is
for every
the same
household.
thing. I think it's global. I don't even care. At the end of the day, you're paying $35 billion for an in-home gym. When have they ever stuck?
For a future coat rack.
Yeah, that's
Yeah.
right. The most important thing is that it
35
has to
billion.
fold up to go under your bed. That's the most
and
important
by the
feature.
way, here we go. My man Value Stock Geek, 186 or 126 times EV to EBIT.
That's expensive.
Now people are going to be like, well, EBIT's slow and they're investing through the income statement. It's still a subscale. I get it. That is crazy.
It's only
And if that
it's only
one's not
200
crazy-
times EV, but
Dude, if that's not crazy, the whole basket is 100% crazy. Like, if that is maybe the one that I'm wrong on, there's not a chance I'm wrong on all these. And whatever. You think I'm wrong? Bet it. I could care less. I have no exposure and I could care less. Enjoy your life.
So
Right?
what phase of loss is this in the 7 phases?
Kubler-Ross.
Bargaining or yeah.
stages of grief.
Where are we at?
I
I,
think
mean, we're close to anger.
I'm really not angry. I guess the only thing that I'm angry about is I don't know. I'm angry about like what a bad name not owning some of that stuff has gotten. But then again, that's sort of the two camps of investors, and that's fine. I do want to own one day. Like if I could find one that I could call Minion Capital. I'm looking forward to talking to him. He's a smart dude. If he said like fish here for this reason and start learning, I'd be open to that. I'm just not finding the name on Twitter. Fuck that.
Somebody here says you need to take boxing classes now.
Because of what I'm rocking?
I think they're offering to hand out the punches.
Yeah, they just want to punch you in the face. I think that's what he's saying.
Oh.
Lots of
Why?
aggression to release.
It is
I
well,
don't
we're
have aggression.
we're
Do
all
I
backed
sound
up
aggressive?
in the
So,
value.
what innings are we in?
Probably 2.
2.
Back to 2? We rolled back an inning?
Yeah, I
Shit.
think we did. Didn't we correct the last 2 days?
Did we? I don't know. I thought we were at all-time highs. The answer, like if someone says where are we, if you just say all-time highs, there's like a 50-50 chance that you're right in this market on any given day.
I don't mean to sound that angry. It's just when I look at Peloton and it's a $35 billion company, it's insane to me.
Here we go. Peloton for boxing. Boxing as a service.
That boxing as a service is basically Mirror.
Oh, is that Mirror? Yeah. All right.
Yeah.
Of course somebody's already thought of it.
They're good products. I'm not like a product hater. I just don't understand how you can spend that much money on that product if you want to own the equity.
I don't
And
like
you're probably
Zoom.
going to face dilution.
I'm a product hater. I don't like Zoom.
Yeah, that's different.
I log into it 5 times a day to get my kids into school, so I'm tired of it. There's got to be a better way to log in.
Yeah. I don't know. We'll see, man. Maybe all this makes sense. It'll be an interesting 10 years from here.
Let's turn this back into an investing podcast.
Oh, okay. Instead of
Is it not?
random gripe session.
Whatever. You guys take over.
Toby, you want to talk about your
Yeah, so I've been like looking at some of the better performed businesses out there, just to try and back into some of the valuations and see, what's interesting. So, basically the way that I did it, I just went through a list of the guys who've been on the podcast and the names that they had thrown out. Got a really interesting one coming up with Elliot Turner where he talks about Twitter. I don't want to talk about that one too much, but I think that he's found something super interesting in Twitter because it's been, I love the product. I think lots of people love the product. It's just been hilarious how badly managed it seems to have been part-time CEO, and it's the lesser of the two companies that he's part-time CEO of. He's clearly a very smart guy, though. He's probably still doing quite well, but the business behind it has been what looked like a bit of a shambles, and it's sort of turned into, maybe with Elliott, who was a very scary hedge fund, and Silver Lake, who's a very smart kind of private equity VC tech kind of private equity firm, probably something good's going to happen there. And he seems to, Elliott sort of demonstrates that I think that's the case, but I don't want to give too much away there too late. So I went through a list of names. Like Trade Desk was one of the ones that I was just sort of, Trade Desk is interesting, but it's expensive. And I was just, we've talked about this before, but the question I guess I have is, do those base rates continue to apply to these sort of businesses that are networked? And I know that should, is this time different? That should make everybody really nervous when they hear those words. But I think you introduced it, JT, on a podcast a few months ago where we were talking about Mobison's base rates, that he brings out sort of, it's like revenue growth, return on invested capital, like what proportion of companies can sustain these. So like if you've got $50 billion in sales, what's the likelihood that in 1 decade you continue to have, extraordinarily high growth rates? And so, it's hard when you look at these things because they're all expensive, but they are all very good businesses too. So if you assume that they can maintain their rate of reinvestment, and they're very high rates of reinvestment on very small capital bases, even though they're expensive, they can continue to grow very rapidly. If you just assume that there's no fade in any of those rates, then they're probably going to be, you're going to make a lot of money out of these businesses. But if you would assume any kind of fade rate, so like they don't continue to be exceptional businesses in a decade. So if you assume 25 years, that's no fade. There's no fade at all in the margin. So there's somewhere between 25 and say a decade do these fade to kind of reasonable businesses. And I just found that basically the entire decision rests on how quickly these companies fade to average. And it makes me a little bit nervous. Like some of them are clearly going to last the 25 years. I mean, I don't know which ones, but it's Amazon is still a beast, even at the size that it's at. I don't know if it can continue to grow at the rate that it has, but it continues to, like, it's still got a very high return on invested capital. It's still an exceptional business. It's hard to see how anybody really competes with it other than maybe Shopify kind of doing Shopify has
rebel against the empire,
funding the rebels against the empire. Like I think that Shopify is a very, very robust approach to it, and Shopify's growing rapidly, massive returns. Just again,
so
like
expensive.
Crazy expensive. Like it's hard to see how you make much money out of that over the next decade, even if it keeps on doing what it's doing.
You got to get rid of that limiting belief that valuation matters.
Well, that's entirely true. If I just ignore that, the returns would be much better over the last few years. I mean, I think there's a good question on the board. How long before cloud becomes a commodity? I mean, I don't know the answer, but it can't be. It's not forever. Like 25 years, that would be a long time, right? 10 years.
I just don't know what you're bitching about because I have this up here and it's only trading at 22.7 times 2024 gross profit.
Shop?
No, the trade desk. You just need to extend your time horizon. That's the problem.
Well, being sort of like, we're always a little bit facetious about this, but you put interest rates to zero. Like it's probably not entirely unreasonable to think that you bring all of that forward without discounting it.
Okay, let's actually go into the constituent parts that make up that number. How do people get comfortable coming up with a revenue number that far out and a margin? That's even harder. Because a lot of that has to do with competitive dynamics, right? How do you?
Yeah.
I mean, you know what to put in, or do you just know what the number you need to get to, and then you solve for? Well, I need 80% gross margins. All right, plug that in.
I think that I can almost understand the 2024 number. It's the 2030 number that you have to believe in that I really can't get to.
I think you can see it, like not see out, but there's probably not much diminution in a business over 5 years, or there's not much of a change. You just assume some modest fade over 5 years, out to 10 years.
Then none of these numbers work if you
That's
do
right.
that.
Well, out to 10 years, they certainly don't. That's the problem.
So
and 10 years, I think, is
Phil
pretty
Tedlock,
modest.
who's the like a guru when it comes to forecasting, right? He's done all the forecasting research. He says that anything past 5 years in a forecast, you can pretty much laugh it off because they're never accurate. So more than 5 years, like he ignores anyone who says anything that's more than 5 years out, and it's safe to ignore that. So I don't know, how are these people getting comfortable with numbers that are 10, 20 years out? I just find the whole thing to be a little laughable myself, but much to my
poverty
detriment. Yeah.
Yeah, I don't know.
You gotta believe a lot of things, and you gotta believe that a lot of things are winner take all. And I guess that there's an argument to be made that data is the new oil or whatever, and there's going to be some
it's a commodity
advantages.
that sometimes you got to pay to give it away.
Ooh, dang, hot take.
Fire.
Yeah, I don't know. I mean, you just got to believe a lot of rosy stuff. That's how you get there.
I mean, the counter argument is, because I know there are folks out there just pulling their hair out listening to us talk about this. The counter argument is that these are good businesses. They're probably still going to be pretty good businesses in 5 years' time. And you get another, if you just think, well, I'll just look out 5 years, and then in 5 years' time, I'll look at another 5. In 5 years' time, they're probably still going to be pretty good businesses. They probably haven't faded to the average business by that point. And if you can,
I'm very curious. I mean, Microsoft, great business in 1999. It took you what, 13 years, 14 years to start making money again in it? Are all these people that long on their horizons where if they're going to sit in something for 14 years before it starts getting into positive territory again? I don't know. We'll find out.
Yeah, that's right. But you also had to foresee that they became a software as a service. I mean, they had the thing that made it really hard, when everybody was pitching it in like 2011, 12, 13, that kind of, when it was like at all the Value Congress. It got pitched a few times at Value Congress. And the problem was that they had their first year of revenue dropping I think in the life of the business. And so then the question was, do they keep growing again, or can they sustain their margins if the revenue's coming back? You had to kind of, take my hat off to Alex, Science of Hitting, because that was when he bought and he hasn't sold. So he just said it's good enough where it is as a value stock, and then he's caught the ride as it's become a growth stock and held on the whole way through, which I think is hard.
Sounds like a much different skew, that bet, but what do I know? I'm a noob.
What do you mean it sounds like a different skew? It sounds like his bet was his was a good bet.
Yeah, that's right.
Yeah.
It's a completely different conversation.
To where it is now.
I'm looking at the free cash flow estimate on Trade Desk. Right? You're looking at 1.5 time free cash flow yield, 2024 consensus free cash flow. 1.5%. That's tight.
And it's not.
What happens if that goes to 3?
And it's not paying out that free cash flow. That it's reinvesting. Like this is the difficulty that you have with these things. Like it's. I think that from the top of my head, the free cash flow was like 125 million. Is that right? Something like that.
132. Yeah.
132, and then.
Well, yes, but that's inclusive of share based. Okay. Just so we're on the same page.
Telling me there's a chance.
But then you have a look at their financing cash flow line. Like they've also raised like 100. It might have been 128, something like that. But I just looked at that and I was like, well, there's no real free cash flow here. That's reinvesting. So that might be a great thing. Like they're clearly reinvesting at a very high rate, so it's going to grow very rapidly for a long period of time. So I'm not criticizing the stock. I'm just criticizing the assumptions, or thinking about the assumptions that I want to make to get comfortable buying something like that. And I kind of want to see it down 90% before I think.
It's not going to get that jump in.
That's why I'm a deep value guy.
Oh, I don't know, man.
I'd be interested in LS Value's take. That guy's been pretty right on this name for a while, if I recall correctly. But I don't know, man. There's just a lot of dilution. And it's a long time to wait. And I saw a lot of people panic in March. So we'll see.
Yeah, I think that's really the better way to do it is to get your list of things that you really want to own. And then you're going to get some, and this is Value Stock Geek pointed this one out to me. Thanks very much, Value Stock Geek. You get this fear and greed gets under 20 once a year. Go to take your shopping bag and go and pick up a few things off the shelves when they all go on sale once a year. And you don't have to fill up, like just get your little starter position in them or get some. And keep some cash. And then I think you can kind of squeeze your way into these things over time at pretty good, at least a better valuation. Like I just don't think now is the time to be going and doing it. If you go and look at fear and greed, it's the other way. It's telling you to be very, very careful. If things are expensive, fear and greed's off the charts. Put call ratios off the charts. This is as bulled up as anybody gets. This is February 2020.
Here's what I do think is sort of interesting. When you start to get the put call ratios off the charts, and like I've been listening to more of these like market guys, a lot of people are saying liquidity is just not there. And, a valuation is sort of the next price that somebody has to pay to get the shares out of your hand, right? At least in the short term.
Just so that last line again, valuation is the...
Well, like price is just where something trades, right?
Right.
It's just you've got like this shareholder base that's just one and one and one and one, and they have like, you cannot deny that the trade desk shareholders have made a ton of money. So now you got a huge run up in a stock that you like on a business that you think is going to dominate for a long time, and if you bought early, you got to incur taxes to sell that. Like, I understand why the shares are hard to acquire and why the price would go higher, but that's like a supply-demand dynamic. That's not like a valuation dynamic.
The shares are trading. That's sorry.
I understand.
That's state the blindingly obvious, but that like to get there's clearly some marginal seller there at each price because they are actually going through. There's quite a lot of volume.
Yeah, you're right, but I just think that the incremental. It's obvious by the price, right? The incremental demand exceeds the supply of sellers, but it just seems to me that we're closer to trading on that dynamic than we are valuations.
Do you think it's well, that's the one thing that I found going across all of these stocks that are kind of better businesses. I think that the one criticism that I have that is fair about me is that I just haven't looked at these because they're so expensive. I've just ignored them because they're not things that I would buy. But I thought I should go through and have a buy price for all of these stocks. So I just went through and created, and not completely, but creating my list of like where I would buy these things, where I would feel comfortable that you're going to get about a 10% IRR to their fade over a decade, just to give you an idea of how I'm doing it. And every single one of them is like 50 to 60% over where I think you can get that, which means that you almost, what that means is that you're basically not going to get much return for the next decade out of these things, even if they keep on doing what they're doing.
Or you're fading too quickly, right?
That's the other thing. Well, that's why I'm trying to get an idea whether I am fading too quickly and we should be looking at, maybe we should be using slightly different metrics. But I'm also aware that I'm asking that question right at the very top. Well, not at the top, but in a very bulled up market.
Third inning,
yeah.
Yeah, look, I think my sense is that these will probably outperform what the base rates are. So we'll probably have a step change up in base rates. That said,
so the previous, if we use Bayesian updating, the previous base rates are not applicable as a population to this new batch. So this time is different.
Yeah, I think for the revenue model that these companies have and for how quickly they can land and expand, I think it's very possible. But I also think like a lot of these valuations require believing in people being able to have product extensions and people being able to land and expand. And this is why I always say as a bucket, right? Like, or as a basket, It seems to me that once you start to get to this aggregate valuation, they have to all succeed bumping into each other.
Yeah.
And maybe that's way too simplistic. And maybe the TAMs are just way, way bigger than my pea brain can ever, fathom. But I guess why I'm so skeptical on it is you're forecasting so far out in the future and we're still early in a trend. And I just think that those two combinations combined with human greed and groupthink lead people to have a huge bias towards the upside of that because it's motivated reasoning comes in, and then price fulfills, that reasoning, and then it becomes destiny, and then you get stories of how reflexivity is reality, and the story just gets bigger and bigger and bigger and bigger, right? And when the share prices are going up, very few people say like, guys, this is bullshit.
You get to feel very smart too, right? Like you saw something that no one else saw, and now you're getting paid for it, and you're getting paid like every day.
Yeah,
Boy,
and they're
talk
getting
about
paid a
wiring.
A lot. And like, you know what? They're playing I don't know that it's a smarter game. They're getting richer than I am. But like, I'm doing fine, whatever. I'm here talking about not working this month, so it's not like I'm crying.
I think you're right though we've talked about this, the total eventual supply of all of these things that they're supposed to be doing in a B2B or B2C kind of way. Like, how do they not run into each other and start competing? I mean, it doesn't make any sense to me.
I mean, the other thing is you don't have to do anything with these companies at this price either. I look back, it was only 2018 that they were all trading pretty cheaply. It could easily happen like in the next few years.
I think Phil Ordway on John Mihalkovich's podcast said it the right way. He was like, I don't want to start talking about these companies' valuations because I think it distorts how people think of things, right? And like, I'm just interested in learning about these companies. That I think is the right approach. I just get super nervous when I read about how great CrowdStrike is, and then the one guy that I call that like I really trust is like, stay as far away as possible from that thing, right? And it's like, okay. I mean, I trust him over Wall Street 10 out of 10 times.
On the basis of the business or on the basis of the valuation?
He's just like, look at how long they have to do what they're doing for the valuation.
Oh, I see.
Like the implications, and then find me a cybersecurity firm that's done that sustainably over time. And he's like, it's a terribly difficult space to grow in, and this guy worked in it. So what? I'm going to believe your research report? No way. He might be wrong, right? Like, it's possible, but if I'm going to risk my own capital, I'm not fading somebody that I trust over something I read in a document. No way.
I think
I read it on Twitter. It's got to be
true.
Real. It's got to be true.
Let's do JTs. We're gonna run out of time for questions at the end.
People are gonna hate this episode. We're gonna get so much hate mail.
I know. I feel like it's.
Which
the bar
part
has been raised too high for these veggie segments.
Just a bunch of grumpy value guys railing on growth.
You just don't get it, man. It's a new paradigm. It's called returns on scale. All right.
Why not?
So I titled this one Magic Numbers, and I noticed in different contexts, the physical world, biology, that there are occasionally these weird numbers that kind of just pop up randomly. And it's like, well, why the hell is that the number that shows up consistently? So the first one is in a river, the meandering of a river has this mathematical function that is called sinuosity. So like a sine wave. And in both simulations and empirical data, this meandering process kind of self-organizes the river's morphology. Like a river will kind of evolve into a certain shape and length. And the bends in the river are caused by erosion. So what happens is the outside of the river on the bend is moving faster than the inside. And it will erode the dirt and keep moving further out. And what ends up happening, the water that's moving slower on the inside will deposit dirt there. And so you get these turns of the river. Well, balanced against that, eventually if it gets too kinked, the water will basically cut through that line or will take the shortest direction and will create what are called like an oxbow lake. So it's like it kind of takes the straight path shortcut and it makes like a little lake out of it. And so you have this tension between the erosion and the oxbow lake effect. And what's weird is that there's this mathematical relationship where the river's total length, like if you followed it along, and the source to the mouth length, when you divide those together, you end up with pi. So
what?
3.14 roughly. Yes. So, like, why the hell is that a number that just shows up? I don't think anyone knows the answer to that. Based on, I couldn't find it. Looking for like, well, what's the what's the causal explanation for why we get 3.1 out of this? And this is on average.
It's
like
not 3.1, sir.
What?
Pi.
Well,
it's a very
okay.
specific number, sir. Don't round it off.
I was rounding a little bit.
He did say pi.
Yeah, you could say pi.
He did say
should
pi.
Give it the respect it deserves.
So
It's like Fibonacci sequences. Sorry.
Right.
Continue. People don't like this when I do this.
That's okay. So yes, there are variations based on geography and topology of the land that will change that. But when you like average these things out, you end up with pi, which is like, why the hell is that the case?
I thought you were going to say they all sort of roughly follow the same shape, and I was going to say, well, that's just because water's the same viscosity roughly, and then you. But no, pi. That was a little bit unexpected, I got to say.
Yeah, pretty random. Kind of a magic number.
Yeah.
So the next one is you guys might. I think we've talked about this a little bit, maybe not, but Jeffrey West, who's this. He's a physicist and a bunch of other stuff. Pretty polymath guy. He wrote this book called Scale, and you can watch the TED Talk that gives you like most of what's in the book. It's quite interesting, but he's talking about how like if you gave West some census data about your city, he could tell you how many gas stations you probably have, how many patents you produced, what the GDP of like your little area was. And it's all based on these mathematical relationships. And it actually emerges from like the topology, like the structure of the networks in a city. And they're like the human element of the like spread across this topology leads to these mathematical relationships that are repeatable throughout, like doesn't matter the culture, which is quite interesting. So it, in the case of patents and even like crime as well, there's this super linearity that's demonstrated. So you have, for every doubling of the population, you end up with like 1.15 as much of like over and above what a doubling would be. And so it's not a perfect like, oh, well, we doubled the population, we get twice as much crime, twice as much. No, it's 1.15. And across like different domains too. It's like, well, why the hell does that happen, right? Like, where's these
and what is it?
numbers come?
What's the reason? We don't know.
Well, I mean, yeah, I don't know if we know like exactly which way the arrows point in these things. Like, there's just sort of these emergent phenomena based on when you have interacting networks or nodes in a network.
Can you work backwards
laws of sort?
Yeah. Can you work backwards and seed like the if you know that you want some sort of outcome, you seed a university in somewhere and you get.
I mean, maybe
hasn't been considered. Wasn't part of it.
Is that what China's been trying to do? Like, they've got how many 100 cities that are more than 1 million people? I don't know. There's this other interesting mathematical relationship that's called Kleber's law, and it has to do with, in biology, with the metabolic rate of an animal compared to its mass. And so like there's this kind of relationship where the bigger the animal, the slower its metabolic rate, the slower its heart rate. Like, I don't know, a blue whale its heart will beat like, I don't know, 4 or 5 times per minute. Whereas like the pygmy shrew is like 10,000 times a minute or something like that. And has like a much higher, like a much higher metabolism than the blue whale. So there's like another number there that emerges. So, all right, we've demonstrated this in sort of like the world of physics. There's these weird numbers that come up. In the world of biology, there's these weird numbers that come up. What about in like human, and in the investing context? Couple interesting things. Like, one is, Jeremy Grantham talking about how profit margins are like the most mean reverting data set, right? And it's like 6%.
Until recently.
Until recently, although I just looked, and with COVID, like the trailing 12-month, I think, is something like 7.1, whereas before I think we were up at like 12 or something for a while. So maybe we are.
You think we're mean reverting?
Everyone's, well, I don't know, maybe. Even though everyone says that this is like that relationship is broken now. Yeah, we'll see. I don't know.
Because I've been quoting
Maybe Jeremy's right.
I've been quoting Grantham, Buffett, Hussman, all saying exactly the same thing for about the last 10 years, 5 or 10 years, and that's been not true.
And you've been called an idiot
repeatedly.
Yeah, Buffett has a pretty good quote where he says that, and I think he must have been talking about this in 1999. He's saying that some people tell him that there are more lawyers than there are people in New York, right? Like the base, like the one component is somehow going to grow and be bigger than the aggregate, right? Like that, it just doesn't make any mathematical sense. But he's talking about how you have to be wildly optimistic that corporate profits as a percentage of GDP can, for any sustained period, hold much above 6%. And so, like, why is it 6%? Like, why does that number pop up here? I don't really know the answer. Like, something about capitalism puts you at like 6%, and it's probably no accident that some number, I've seen different numbers for this, but like one of the numbers I've seen for long-term returns on stocks it's like somewhere around 6%.
Yeah.
It's similar to like what the business can produce. So
it's also it's the inverse of the long run. Schiller PE is 16.
That's right. That's a good
falls out of the same number.
Yeah. So like there's a couple, like I think what was interesting to me was like I was sitting around trying to rack my brain, like why aren't there more of these sort of emergent magic numbers in the investment world? And I think what it tells us is that there's less logic to this maybe, and less like physics sort of, certainty, and that it's a lot more random than that we don't have more like real numbers. And I know some guys are going to say like, oh, there's what sort Fournette waves. I think you've talked about that before, Toby. Those are kind of these, or is it Sornet?
Sornet, yeah.
Yeah, Sornet. And then you get like Fibonacci numbers and things like that. But I find it interesting that there are not that many sort of like magic numbers that emerge out of the world that we like to spend our time in. And then maybe that tells me, dude, this can get crazy, and it's like there's no physics as much to like sort of keep it tethered to a reality, and you just sort of have to accept that that's the domain that you're living in.
There's also actors in it that aren't economic, so the Fed, and you have regulation as well that can bias those numbers up and down, maybe for a period of time, maybe for an extended period of time. It could be decades. But I think that the very long run means are probably closer to physics than...
Yeah, I think that 7.1% right now profit margin, dude, that's with us shoveling how much money out the door into all of these companies?
Plus interest rates are very low, which means that your consumers got money to buy.
The whole thing is goosed to get to stay at 7. I find that to be a little bit frightening.
And then pin rates down really low, which will bias up your multiples.
And now we figured out why.
Now you know where we are. Where we are.
That's why we are where we are.
The only problem is that if that figure ever comes off the scale, then I think we go back to stasis. Maybe it goes back anyway. I don't know.
Well, what if you have to like live some time below the mean ever?
I mean, it's happened in the past. Like that's literally why it's the mean.
Yeah.
Not in the last 25 years, but before then.
Well, a lot of people are living below the mean. They just don't own assets.
Well, we're talking about, the average valuations, but yeah.
Yeah, but maybe that's the answer, right? You just get higher and higher. Maybe the risk is not in the capital markets. Maybe the risk is societal.
I 100% agree with that. Yeah. If you put your hand on that scale too much, then you bias the asset owners and you hurt the folks who don't have assets, and then it shows up in consumer inflation. You really hurt the people who don't have much money, and then you get a revolution, and then the people at the top lose their heads, and you start the cycle again.
So you're saying that risk can't really be
there
destroyed?
We go.
It's just transmuted into a different form,
There you
which
go.
would be in this case maybe societal risk.
Is that I think that I've got to give that to Corey Hofstein unless someone has an earlier version of that. But that's the Hofstein. Is there an earlier version of that?
Chris Cole, maybe. I don't know. Those two probably are close together. I don't know who said it first.
I think Corey gets there first.
Both very smart guys, so they can split the Nobel on that one.
Yeah, that's right. That's right.
I appreciate the corporate raider saying that I don't look very good right now. Sorry, sir. I don't get dressed for you.
Is this a fashion
Also, you
podcast?
changed your avatar from my man Charlie Scharf to something else. You and your kid. No one wants to see that. Bring back Charlie.
Charlie Sharp. Throw your questions in, folks.
Try to squeeze some questions in, huh?
Somebody said, "How do we think about private investments?" I don't know.
Same way I think about public
markets are
ones.
much cheaper. Yeah. I have some private investments in real estate, but that's just because I can't do it on my own.
Do you have any thoughts on? So I want to throw this one up here. Discovery. It's been in the acquirers multiple screen, a large cap for a little while, and we've talked about it offline quite a lot. But I saw Malone sold a big chunk of it. Or sorry, I don't know how. It was a lot of money in an absolute sense. I don't know how much of it for Malone it was. It might have just been some lunch money, some folding money, walking around money,
couch cushions,
couch money. You guys got any thoughts on Discovery?
I don't know about his sale. He's always doing stuff for taxes and stuff like that, and I don't really know. I personally don't believe in that entity as much as I believe in some of the others. I just think that there's a big risk in that entity where you have a lot of viewership minutes that are not active, and they're cited as people loving a program, but it's very possible that it's just a program staying on in a room that no one's watching.
Yeah.
And if you start to get into a world where people have to sign up for your service, or we can start measuring eyeballs, I mean, if you think the odds are good enough, bet it, but that's not worth my money.
You got any thoughts on it, JT?
No, nothing to add.
The other thing is, like, Zaslow lives in that big ass house. He throws all those like parties and stuff. I don't know. That rubs me the wrong way. Not that Maffei doesn't, but Maffei also makes bank, so for his shareholders, that is.
Yeah, so Discovery is a tough one, right? Because it's when you had the bundle, it was one of the things that you could put on, and it's kind of it's the least objectionable programming. I think that's what we've talked about it before. You can put it on and you can just kind of veg out and you can watch hours of that. But in a world where you've got everything at your fingertips, are you selecting that over other things? I don't know. I think it's probably everything on demand. It's tougher for that business, and it's not how hard is it to go and make those documentaries. Netflix is running those nature-style documentaries, and they've got money for that, Amazon gold mining type stuff.
Yeah, I just don't know how defensible it is. And I do think, they have good personalities, and they do have, I think, like, the Food Network and Curate together would be an interesting set of assets. I could see how those could work together, and they are forming a partnership.
Targeting the same demographic.
Yeah, and I think that it makes sense that, like, if you're watching a personality cook, why can you not buy from the show? Like, that doesn't make a whole lot of sense to me. I think that they
don't sell the spices. Cooking with my
in the kitchen with David.
Yeah, but that's on QVC, right? Like, what about Food Network or Bill and Joanna Gaines or something? Like, why can't you click some of the stuff in that room that they're showing? Or is it even Bill? I don't know. Backstory. So you're going to own more and more and more of the equity. You're not getting your money out. So I don't know why you would assume that you're going to get a bid on your shares when you haven't. So how do you get your money out? And then you're basically owning it to the end, and I'm not comfortable with that bet.
Well put. Spotify versus YouTube, which is a better business?
From a business quality standpoint, probably YouTube, right?
Yeah.
I mean, one gets everything for free and the other has to pay almost everything in royalties. It seems like I'd rather have the one that gets everything for free. Now, which is going to be worth more, I don't know, because YouTube has not become what I thought it would become. They seem to fumble some chances over there.
What do you think that where were you aiming? What did you think was going to happen?
It's odd to me that Spotify is now the music discovery place for a lot of people, right, in their playlists. Like YouTube had a huge advantage in that, and I think that they I don't know, singular focus can win. And the podcast thing that I was mentioning, like some woman from Anchor reached out to me and she was like, can I host your podcast? Right. I mean, they're over at Spotify. They are very, very focused on winning that market. Now I'm not going to go with them at the moment, but at least you can see how a singular focus, it took Google like 10 days to even approve my podcast. It just got approved on the Google podcast thing. It's like ridiculous how slow they are on that. And it's because they don't care.
There's nobody there.
Yeah.
How annoying is it too that like if you're trying to like listen to a YouTube on your phone, and if you close your phone, like it shuts down the.
Toby's been saying this forever. They're trying to get you to sub.
They're trying to get you to buy the sub. If you buy the sub, you can continue to play it when you close it. Yeah.
If you don't watch this podcast, like the second we close it, it sucks, and you get some weird ass ads too.
That's just your browsing history.
Oh, that's possible.
What I find amazing is how often it gets demonetized. Like anytime we say COVID demonetized, there's $1.98 monetization gone. Sorry, fellas.
Man, there goes my lollipop.
Christmas is canceled, boys.
Christmas is canceled. That's it.
Speaking of which, a lot of people bitched about the merch, and then the merch just sits. Order the merch. Tell me you want more merch. But order the merch. I'll put the link in the YouTube thing. Come on. Otherwise, I'm not going to invest in making more.
Do we have merch?
Yeah, we got. Shut up. Get out of here.
I got. Anybody want to take a swing at Alibaba?
No.
Anybody know anything there?
Don't have anything.
So the last time I looked at Alibaba, I played the Yahoo stub when it went into Altaba, which meant that I shorted out the Alibaba. And it did make money, but I would have made a whole lot more money if I hadn't shorted out the Alibaba. But I took a look at those financial statements. You need to be a much better analyst than I am to understand what's going on in those things. As far as I can see, their main business is creating subs. They create more subs than there are days in the year. So I don't know what they're doing that for. Seems like subsidiaries. That seems like not subscribers, subsidiaries.
Yeah.
You got a legal department just churning out subsidiaries. Why?
Why not, man?
I don't know. It just was
offset all the risk.
Too complicated for me. Yeah. Too hard. Yeah.
Airbnb's IPO, I don't know. I'm almost certain Bill Gates called it the best network effect he'd seen. It was in one of the old Buffett interviews. If you go back and watch like the last 3 or 4, 3 years.
Airbnb?
Yeah,
why?
Because it's a two-sided network of like really, really fragmented owners and a fragmented customer base. I'll check it out. I'll see if I can find it. I'm not going to spend too much time looking though. But if it's the Berkshire interviews when Munger and Buffett sit down is when I think he said it. One of those.
Did anybody look at Zoom? Has anybody taken a swing at Zoom? In terms of valuation?
No, I mean they did have an incredible quarter last quarter. I mean they printed a lot of cash.
There you go.
I will grant them that.
SEC doesn't order the Alibaba financial statements.
I'm gonna say best network effect. Catholic Church.
I mean, Zoom's like
how do I invest?
Times sales, because why
500
not?
years of data on it. One of the largest landowners in the world.
Yeah. McDonald's. Second hand to Macca's, right?
Yeah, exactly.
Like, here's what I don't understand on Zoom, okay? You got huge growth this year. Huge. 262%. Okay? To $2 billion. We're trading at $117 billion, so whatever. Lots of time sales for those that want to figure it out. You got them growing. Consensus is like 40% growth in 2024. Like, okay, why? 40% is a big number. Like, what's going to happen in 2024? I'm looking at it. You got 300% this year. Okay, granted, everybody's locked in, Then next year, we're somehow going to grow 34% off that base, as if people aren't using it like crazy right now. Like, and then you come down to 21%, and then you pop up to 40%, 20. I'm sure they have some product that they're releasing or something. I mean, these people aren't stupid that are modeling it, but how are we going to grow 34% off of this base? Kids are in school on Zoom. You can't do anything without being on Zoom. And we're going to go 34% off that base?
Well, there's one less as of
I can't
yesterday.
wait to get the fuck off Zoom. You'll see me 0 times next year on it.
Yeah. Yeah.
Like every corporate meeting is on Zoom right now. We're going to grow off that base. I don't know, man. I just don't trust that. Maybe I'm the idiot.
Here's the thing. It could work, but you don't want to make that bet 100 times.
Yeah. Yeah,
right.
I think that's right. Your odds offered are really bad. Now, I said the same thing last year. It's 118
I said the same
billion.
thing 200% ago.
Do people get locked in?
Like 200%, dude. It opened the year to $21.3 billion company. Now it's 117.
Do people get locked in to these? Like, does this network effect eventually occur where everybody's just on Zoom and it's just easier to be on Zoom? Or do you think?
I'm sure a bull would tell you that, right?
No way, dude. Skype is just as good to me.
Google
Google Hangout
Google
or
Hangouts.
Google Meet or whatever.
Yeah.
Just as good. FaceTime. I mean, I don't know. Whatever, man. It's
Well,
Yeah.
and like all the people that are sitting at home that started a podcast now that are like recording on Zoom. I mean, think of how many things happened on Zoom because nobody had anything else to do. And we're going to grow 34% off that base. I mean,
It's growing 40% between here and 2024, or it's growing 40% in the year 40% per year.
2022, this is consensus off Bloomberg, right? 2022, the year ended 1/31/2022. You're looking at 34% revenue growth. The year ended 1/31/2023, 21%. The year ended 1/31/2024, 40%.
Why does it take off?
I don't know. This is what I'm
because
asking.
you need that to get to this valuation.
I think I see what I've been doing wrong. I've been fading these things. I should have been compounding them, accelerating those metrics.
Rookie numbers. You need to pump up those rookie numbers.
Like
So
if
I'm
I
doing
was
wrong now.
underwriting this thing, I'd be like, all right, so next year we figure usage and everything falls off like 30%. And I'd rebase my estimates from that.
Well, maybe that's what they're doing.
I don't know. You got 7.4 billion of sales in the year ended 1/31/2025. We'll see. Maybe it works. They are doing a lot in phones. I like their investor day. It seems like a cool company. Better be. They're selling a lot of dreams for $118 billion. If you don't know how to sell it to the street, it's crazy. So.
Wow.
Whoa.
Sobering.
How's your curate Zoom bet going? Let's get an update on that.
I don't know. I think I'm winning. Who cares? I got 2.5 years, man.
Yeah, well, that's fair. I just wanted to see the inflection point.
I think I'm pretty certain that Curate's ahead.
I think you are ahead.
It's going to be tough now. There we go. That's good. Chalk one up for the old value guys.
Yeah.
We're not that we can take a knee. We got 2.5 years to run on it, but
I think
let's
they're
keep
going to have a
going.
really good quarter. The stock market being up helps the wealth effect of the consumer. She's at home. She probably needs some retail therapy. I
doing
think they
Zoom
got
calls.
Yeah. Well, yeah.
Between Zoom calls.
She's going to see David to forget about her pain. We're just selling her air fryers.
All right, amigos. That's right on full time. We're all going to be here next week.
Yeah.
For better or worse.
That's right. Yeah, maybe we'll say something worth listening to next week.
Let's redouble our efforts and come back with something a little better here.
All right, fellas.
I had a great time.
See you next week, folks. Ciao.
Cheers.